Alright everybody, welcome to the channel. Today I kind of want to just take the opportunity to show you guys the portfolio, just what I'm doing, where I'm at with it. Over time this is going to change. I would guarantee things changing. In fact, I'm probably going to be changing something during this video, selling out of a company and probably adding it into another. So stick around for that. That'll probably be a little bit towards the end. But I kind of wanted to give you a quick and brief little synopsis, I guess you could say, about the portfolio, what the goal is, and what I'm doing to meet that goal. So this is certainly a long-term portfolio. I'm thinking 5, 10 plus years down the road. So very, very long-term. Nothing really like within a year. I might have small goals like that I want to complete like within a year with the portfolio, but overall the mindset is to stay in companies for the long term. To describe my investment philosophy, I'm certainly Buffett-esque, where we look for high quality companies and try to enter those high quality companies at a favorable price. So you're not going to see very speculative stocks in this portfolio. It's generally going to be much, I guess you could say, safer, more high quality companies. You could describe them as compounders. Companies that are going to consistently grow their revenue, their free cash flow, their EPS. Companies with great potential for growth moving forward, but not speculative companies that are brand new, issuing lots of shares, companies that have lots of debt, companies that aren't even profitable. You're not going to see that in this portfolio. So now that quick and brief summary is out of the way, we'll go ahead and hop in here. And we're going to see the top holding in this sector being MasterCard. I think we pretty much all know about MasterCard. Payment processing company. So if you have a debit card or a credit card that is a MasterCard issued by, a bank, every time you go and swipe that card or insert the chip or even pay online, that's going to go through MasterCard's network. They're going to essentially perform the logistics behind what a transaction is. And they take a little cut of that. That's not the only part of the business. They have another part of the business where they sell data, but I'm not going to get too specific into each and every company. Next, we have S&P Global. It's a fairly simple company. They do credit ratings. They also have another portion of the business revolving around indices. So think if you want to invest in S&P 500 ETF, well, guess what? S&P Global owns that index. So any ETF that is based around the S&P 500, S&P Global essentially gets a piece of that. Next, we have Visa, pretty similar to MasterCard as well, especially in the payment processing area. They're going to be a little bit different in like the data portions of their companies with slightly different strategies. But for the most part, overall, they're fairly comparable. Obviously, growth is going to be a little bit different. MasterCard's a little bit more focused on global reach, whereas Visa's a little bit more focused on growth here in the United States. Both are absolutely great companies, both fantastic. I love being in both of them. Again, similar to that little combo of MasterCard and Visa, we have Moody's, which is sort of a combo with S&P Global, as they're both the largest credit rating companies in the world. Moody's, as you'll see, is down a little bit here. I opened this position in January of this year, so it's only been a few months, so there's really not been a lot of time for the position to grow. The credit rating businesses are doing kind of flat this year, if not down a little bit. Overall, just not great returns. This is especially due to the high interest rates at the moment. With interest rates being so high, not as much debt is being issued, so there's not as much credit rating needed. I don't think this is a big deal long term. Once interest rates go down, these companies are going to start shooting back up in price. They're very high quality companies. I wouldn't say there's anything to worry about. It does seem like interest rates are going to take a little bit longer to come down than most people thought, but that just gives us as investors more time to add more to these positions at a lower price. Then we have Intuit. Intuit's an interesting company to talk about. They're mainly like an online service business. They have a lot of different brands and a lot of different services that they provide. I'm sure the main one that we most know about is probably TurboTax, the online tax software. They also have services like QuickBooks and MailChimp. So a lot of services that small businesses are able to utilize. I'm sure many of us have probably done our taxes with TurboTax just for the sake of ease. Or if you have a small business, maybe use QuickBooks or maybe use MailChimp. It's a company that many, I say normal folks with quotations, but non-investors probably don't think of Intuit much. It's probably a company they never even consider. But from an investor's point of view, they're a very solid company with great financials and great growth prospects. And then lastly, here in the financial sector, we have W.R. Berkley, which is an insurance company. Not really too much to say about this. It's a smaller position in the portfolio. I think it's actually the smallest. Like I said, insurance company, not really a ton to talk about. because it's insurance, but pretty good return so far. Again, if we look at Visa, similar to Moody's, I entered this position in January, so the gains aren't anything crazy at the moment, but like MasterCard, Intuit, W.R. Berkeley, they've all done very well. I think I started all these positions sometime last summer 2023. S&P Global as well, summer 2023, I believe, if not a little bit sooner than that, certainly in 2023. But with it not performing as great due to the high interest rates at the moment, that's why the returns aren't anything crazy. But like I said, I'm really not worried about it. Now here in the tech category, the exciting and fun one. I say exciting and fun because I feel like this is where most innovation is, and this is what many investors focus on. Especially your speculative traders rather than investors. They're going to be looking at Nvidia. They're going to be looking at all the chip stocks, especially now around early 2024 with all those companies just racing up. I mean, as a long-term investor, you probably shouldn't get too excited about things. But to get into it, we can go ahead and talk about Google, which is again a fairly new holding. I believe I just started it this year in 2024, and it's already the largest in the tech category. I'm pretty bullish on the company. Google's traded down quite a bit due to issues that you would think you would look at the company and say, ooh, that's really bad. I wouldn't want to invest in that at the moment. They had a pretty botched presentation where they were presenting an AI platform, and it turns out that the presentation was essentially entirely fake. They made it seem like you could speak to the AI and that they would return the information to you, speaking back to you, but it turns out that you actually had to type in the information, and it was much slower than they made it seem in the presentations. It was a really bad look. You don't want to see a company faking a presentation. Also, even more recently than that, with Google Gemini, they had a little bit of issues with the pictures that they were producing. You would type in like create an image of George Washington, and they would return you a picture of George Washington, but he didn't quite look how he was supposed to. And this went for many notable figures, just not quite accurate. It seemed like Google probably overreacted on the bias that they were trying to account for, and wasn't really a good look. But again, I don't think that's something to be overly worried about. These are small-term news events that might have an effect on the stock price, but are they going to have an effect on the fundamentals of a company in the next 5 to 10 years? These small things, no, I don't think so. Next here on the list, we have Amazon. Again, another company I'm pretty bullish on. 99% returns. I would say that's pretty solid. I want to say I opened this position January of 2023 when tech was like destroyed, just doing really, really bad. Yeah, like I have an average price of 123. It's currently at 186. A lot of tech companies were very undervalued at the beginning of 2023. So Amazon was a position that I started then at that time, and I'm still continuing to add. 186. I don't believe is a bad price for the company. I don't know how much I'm really going to be continuing to add to it. Probably a little bit here and there for sure. But if there's better value somewhere else, I'll probably add to that. Then we have Enphase, and people might be calling me out a little bit saying, oh, but I thought you avoided speculative stocks. Even these next two positions, actually, you might be saying that. To give my thought process on Enphase, if you look at the financials, despite this being a pretty poor time for a company surrounded by solar, especially with the high interest rates, they've actually not done as bad as you'd think they would. I think for the high interest rate environment that we're in right now, Enphase financials have actually been kind of resilient to it. They've not done as poorly as many other solar companies have. Enphase has a good, solid product. They lead their market. I think in the future, when we look back on the solar industry, Enphase is probably going to be fairly steady up in the top, because many of the companies that they compete with, they're not as steady and consistent as Enphase is with fairly high interest rate. Now, I will go ahead and say now, I'm not entirely confident in Enphase. It can certainly be a tricky company to hold. It's very volatile. It might trade up a whole lot one day. It might trade down a whole lot another day. I believe if we look at the year to date, it's down. Yeah, it's down like 10% for me in the portfolio currently. And then overall, just the year to date, it's about down almost 11%. So it's definitely kind of tricky. It's certainly not as consistent as other companies in the portfolio, but I think this is one of those companies that in the future they could really be a massive player in the solar industry, and that this could really pay off. So for now, I'm not necessarily adding to the position because I don't really want it to be overweighted in the portfolio, but I think I'm going to do my best to stay convicted about the position and stay in it. Next, we have Axcelis Technologies. They don't make chip, but they make some of the machines necessary to make chips. They make ion implantation machines, and I'm not going to go into that process of what those machines do, how they're made, how they work. That's a long process. It's very complicated. If I'm being 100% honest, I understand the idea of how they work. I could not tell you how they work exactly. This is a much smaller company in the chip space. Their growth has been pretty solid so far. Again, it's not a company that's super consistent and predictable, but I think over these next few years, they could greatly benefit from this chip boom, I guess you could describe it. Next, we have Applied Materials. I want to say similar to Axcelis, they make machines that are needed to make chips. Applied Materials is a much more broad company than Axcelis. Axcelis mainly makes one type of machine to do one type of process in the process of making chips. Applied Materials makes many machines that are used in the process of making chips. They're much more broad. Again, similar to what I said about Visa and Moody's, Axcelis and Applied Materials were both companies that I started positions in January. You can see one has worked out much more than the other. It's not surprising when you actually look at the financials of the company. While Axcelis isn't bad, it's a much smaller company than Applied Materials. Applied Materials is much more consistent and predictable. Axcelis, not so much. The play with Axcelis, again, I don't think Axcelis is bad. I wouldn't have bought it if I thought it was bad. But Applied Materials has clearly been, I guess you could say, the correct choice. And then we'll move down here to Microsoft. I think Microsoft is actually probably the best company of the 6 that are here. But the reason it's a small position is because it shot up in price so quickly. Again, this was another company I bought back early in 2023 when tech stocks were super cheap and they were down. And since then, Microsoft has just raced up, and I haven't really gotten the opportunity to add more at a reasonable price. I would love to, because I think the company is fantastic. They're very predictable. They're very consistent, but I'm not gonna overpay for it. That can lead to reduced returns, and if there's better value somewhere else, I'm gonna take it. Then that gets us into this ETF section right here with SCHG. I want to quickly explain this one. I just started this position within the past week, I believe. I had about $3,000 just sitting in cash, just in a savings account, and I didn't want that just sitting there losing value to inflation and not growing. So I said, all right, I'm gonna go ahead and throw this in an ETF. I'm going to essentially use it as a cash position for the portfolio. I could have gone ahead and added it into some of the individual holdings, but again, I really wanted to focus on the price that I'm buying these companies at. So I figured if I can just throw this into an ETF, use it as a cash position, so I'm still getting some sort of a return from it, rather than it just actually sitting in a savings account. I felt that would be better. Of course, right now it's down. I bought $2,000 worth, and it's down, just a hair. That's mainly because this past week and the market was not good. We got a pretty hot CPI report. Inflation was a little bit higher than expected, so the whole market's trading down. But I'm pretty sure SCHG hasn't traded down as much as the S&P 500 has. So hopefully this continues outperformance of the S&P 500. I don't know how long this money is going to continue to stay in SCHG. I don't really want ETFs to make up a big portion of the portfolio. I'd much rather than be in individual companies, but this was just for the sake of getting it out of cash and actually getting into an asset that is producing a return. And then here we have healthcare. This one's a big topic. We have United Health Group. They have not been having a good year. If we go ahead and look at our year to date, it's down 17.5%, a little bit over that, which is $226. Certainly a bit rough. Easily the worst performer of the year for me so far. I'm actually negative returns all time. I would like to quickly explain what's going on here. United Health has kind of run into a little bit of rough news this year. They were hacked, and supposedly some information was leaked. There's also some information in their financial reports that weren't exactly favorable, but I would say the big one was this hack that they incurred, the cyber attack. It seems like many people are taking this as a pretty big deal, and the stock has fallen quite significantly for that. But from my perspective, I don't see it as a massive deal. We still don't really know a whole bunch about what happened, what was leaked, how was it leaked, how is this going to affect the business in the future. Despite this, I'm still fairly confident in the company. It's trading at the price of $439, which I think is super underpriced. I'm buying it at anything below 500. So this is certainly a company I'm going to continue to add to, even despite, the bad news about it. Could I end up being wrong about this? Could this cyber attack really be a big deal? There's also an antitrust investigation looking at United Health as well. Again, I don't really see this as a massive deal. The DOJ will open up these investigations of antitrust in the company, and it really seems like they're just trying to get money out of them to pay in fines. But United Health has such incredible cash flows and revenues that even a fine's probably not going to affect them too much. They'd have to fine them an incredible amount. So yeah, this company might not be performing all that well year to date or even all time for me. But again, I'm really not that worried about it. I'm going to continue to add to it while it's below 500. I almost hope it keeps trading down so I can continue to get it at a cheaper price. Now we're going to move into our consumer portion. We have two companies here, Texas Roadhouse and Dollar General. Texas Roadhouse, pretty standard, awesome restaurant. If you haven't been to Texas Roadhouse, I highly suggest you go. This is your classic steakhouse. There's nothing complicated about this business. It's not like Axcelis Technologies or Applied Materials, where it's some complicated process about them building highly complex machines to help them build chips and semiconductors. Texas Roadhouse, you go in there, you sit down, you get you a steak, you pay, you leave. It's high quality food for a pretty standard price. If you go to a Texas Roadhouse and you don't wait for at least 30 minutes before you sit down at dinner time, then that's incredible. Every time I've gone, I've had to wait for at least 45 minutes, even if I've put my name down on the list early. And then we have Dollar General. If you've been looking at this company for anything longer than a year and a half, you're going to look at this and be like, dude, what are you doing? This is not the company to be in. And I'm going to be honest, I agree with that. The thought process behind this position is it's simply a recovery play. Dollar General traded down significantly last summer. They had many issues with the fundamentals of the business and the financials. They were moving in the wrong direction. They ran into a lot of issues with their management, with their inventory. The financials looked bad, and they just shot down in price. So we can look at the price of Dollar General over the past 5 years. Before the big bad issue happened, it was a fairly consistent company. They were moving fairly decently. I mean, you can see the returns here, certainly not bad. But once we get here to like the end of 2022 and the beginning of 2023, it's just kind of fallen off a cliff. It's been recovering fairly decently for the past few months. This little peak right here, it's nearly 50%, but this little drop off right here in the past week has kind of got me feeling a certain type of way. I'm considering selling out of this company. I didn't necessarily want to be in it in the first place because of their financials and the poor predictability, the poor consistency of the company, which admittedly does go against the philosophy of the portfolio. But I looked at it and saw I don't think Dollar General is going to go out of business. I don't think they're at threat of going bankrupt. And I'm sure they can get back to where they were before they ran into the issues that they did. So I got into this position as a recovery play. But the past week with the hot CPI report, it's definitely sent the stock price of this company down a little bit. If we just look at the last week, I'm down almost 7.5% just on the week in this position alone. Now, I don't want to be too emotional and move out of a position just because it's trading down when the trend is that it's trending upwards. But when it's a company that I already don't have too much confidence in, I think it makes a little bit more sense to be reactive to how it's trading. We can go ahead and look at when I was buying Dollar General. And these two first buys were certainly mistimed. Being in August at around a share price of 156 here, 132 there. I mean, you can see how far it fell in 3 days. Again, I bought more in October as it had fallen even further. I realized with those first two buys, I was buying the dip and it just kept dipping. So I continued to add more, and I haven't added more since because I didn't really want this position to become too big, and it really was meant to just be a recovery play. I think that's what it's gonna continue to be. I was debating literally during this recording whether I was gonna sell out of Dollar General like right now and move this money into another position, or if I'm going to hold on to it. But as I was talking and explaining it to you guys, it is trending upwards. It is recovering. Year to date, it's up 5%. But if we look at the 6 months, it's up 30%. It is down 7% in the portfolio over the past week, which is not fun to see. I don't like that. We go here and we see that all time the gains really aren't anything special. I could just sell now, take those $43 that I earned and put it somewhere else. But I think I'm just going to stick on to it for a little bit longer. We're going to see what happens. But of course, I still am considering selling out of Dollar General and adding it into the United Health Group position. This is trading down so much. I love the price here. It seems like it's going to continue to dip. But of course, I can't time the market. I don't know where the price is going to go. I just want to show you guys the holdings all together in a list so you can kind of see, you know, the weights and where the top companies are at. So of course here at the top is SCHG. Like I said, more so just a cash position for me. This money over time will hopefully get dispersed into these companies as I see value. UNH is the largest individual company that I have in here, about $1,700 in value, which is significantly above number 2, which is MasterCard. S&P Global is fairly similar, and then Google's not too far behind. But this is kind of how it stacks up, and I think this is roughly where I want it to be. I do want these companies up here at the top to be the heaviest weighted companies in the portfolio. I don't have a specific number I target. I don't really care about specific targets. I don't really see that as a big deal. I will say though, I wouldn't mind if Enphase and Axcelis were lower weightings because they are so volatile. They could easily trade down 5% in a day, but at the same time, they could also easily trade up 5% in a day. Some people might see this as really nice because there could be potential huge gains. The volatility is kind of rough for me. I'm not the biggest fan of the volatility. I would much rather things just smoothly go upwards. If they have small dips here and there, no big deal. But these companies do definitely kind of play on your emotions a little bit. W.R. Berkley is kind of at an unconsequential. The weight in the portfolio making up $300 of a total $13,000 value. It's not really going to have a big play. I'm almost considering selling out of it just because it's such a small position and I could put this money into, you know, one of these higher positions at a better value. I actually already did this with Apple. Apple was in the portfolio and it had like $200 worth of value in it. It was the lightest position in the portfolio. I just didn't see a point to have a position that small, so I went ahead and sold it. I don't remember what I put it in, but Apple got removed not too long ago. It was trading down this year anyways. The growth potential, debatable, but I mainly just sold it because it was a small position, not necessarily because of future growth outlooks. I almost feel the same way with Intuit. I do believe Intuit's a better company than WRB, which makes me want to stay in the position a little bit more. Of course, not every position is going to be the largest position in the portfolio, so some are just going to be smaller. They're just going to sit down here at a lower value. And that is what it is. But I will say, I do really like concentration. I don't necessarily like a super diversified portfolio. Right now I have 16 positions. I really wouldn't mind if that was 10 to 12 or 8 to 12. That'll probably be a topic for another video where I talk about concentration and the ways I disagree with modern portfolio theory and why I don't like a ton of diversification in the portfolio. Anyways, guys, that's the portfolio. Like I said, about $13,157 worth of value. Pretty decent for me. Hopefully this is going to grow. I have a goal. I do have a personal goal to get this portfolio to $20,000 worth of value by the end of the year. I don't think it's super realistic, but I'm really going to try my best. Obviously, most of that is going to be due to my contributions rather than market gains, but I'm going to really do my best. I hope you guys enjoyed this quick little breakdown of the portfolio. If you have any questions, please leave them down in the comments below. Make sure you hit that like button, subscribe, turn on notifications, do all the good things YouTubers like you to do, and yeah, come back next time. Thank you.